Let's get across the market open now. David Scott joining us from StoneX. Scotty, good to catch up with you on this Thursday. Let's start stateside. Goodness, of course, we had that news that Donald Trump was going to fire Jerome Powell. Then he walked that back, said no, he's not. Interesting to see the market reaction. Perhaps a sign of if he did actually replace him, what would happen?
G'day, Andrew. Great to be back. And you're exactly right. The market reaction is exactly what you'd go and expect. We saw the US dollar go and fall precipitously. We saw US equities go and fall quite dramatically as well. And then the interesting part of what was going on in the US interest rate curve, we saw short end yields go and drop quite a lot in anticipation of a much more Trump-friendly Fed chair being put in place. But the back end was where the interesting action was. We saw a big sell-off take place there. Of course, a lot of those moves went in reverse, but not all of them. So I guess markets are looking at this saying, where there's smoke, there's fire.
Yeah, so in other words, perhaps no one is convinced that he's not going to pull the trigger.
Well, mate, he's been on social media and Truth Social for the past couple of months saying how much of a great thing it would be if Jerome Powell stepped aside, is doing an investigation into our building works at the Fed, and then talking about the potential for fraud. So I think we can all see where this is going. It's just that we know that Jerome Powell, one way or another, is not going to be the Fed chair come May next year. So what's going to happen in that timeline in between, and what person is going to be installed? And will they be able to convince the other FOMC committee members to go and vote in line with what they're looking for?
Do you get the sense that damage has already been done, perhaps the undermining the independence of the Federal Reserve?
Not entirely done, but it's getting close. You could see the market reaction last night. As soon as this question about Fed independence comes to the forefront again, we saw the market reaction. There was no place to go and hide there. It was a lot of volatility. It was a very sharp reaction. And so if you keep going down this path, you keep going and talking about putting in a person who's going to be very complicit, looking to go and run very low front-end interest rates that are probably not applicable for the broader economy, the market will have its end say. And so looking at what's going on with the bond market in particular, I would be very concerned because Scott Bessent, we have Powell want to go and target that 10-year yield. If they want to get that lower, pulling front-end yields down much farther than what they should be is not the answer to do it.
Now, that all distracted from the latest data out of the States on producer prices, which were somewhat more benign than perhaps expected.
Yeah, of course, at the headline level, flat. And interesting looking at some of the detail in between. And this is the one thing that I've been really interested in to see. All this uncertainty that's been created by policy shifts on a daily basis. What will it go and do to broader activity? So we saw the good side of the equation, a 0.3% increase. There was definitely some tariff impacts coming through there. But we saw services prices on the month go and drop 0.1%. So that's more indicative as to what's going on, I think, in the domestic US economy. So you can have a bit of an offset coming through. When you go and take all the pieces out of the various PPI and CPI reports, we're still looking at a 0.3% month-on-month increase for the core PCE deflator. If you go and annualize that out, of course, that's not going to get anywhere near 2% annual rate.
There we go. Then we've got to read there on the graphic. Scuddy, also, of course, earnings season well and truly underway. Well, what are your observations about what we've seen with the big banks?
Well, the market volatility is certainly helping trading desks. That's a given. All the big trading shops have reported either record or very, very close to it levels of trading revenues. When you look at some of the more what's going on in the economy, the other sides of the business that's exposed to the domestic economy, there's not a lot to get excited about at this point in time. And of course, we know that a lot of that potential earnings growth that's already baked into the cake here is all expected to come through from the tech space. We won't go in here for some of those tech titans for another couple of weeks. But as always, what we're seeing generally, the banks have gone and got off to a good start. And more broadly, it looks like we've got another earnings season where there's plenty of beats and not so many misses.
All right. Let's refocus on what we're likely to see locally. Of course, key data today coming in the form of jobs for June.
It will be. And the roulette wheel has been spun, and we'll see what we're going to drum up when it comes to that monthly increase or decrease in employment. The median forecast looks for a 20,000 level. To me, for the RBA, for markets more broadly, the most important figure remains the unemployment rate. And what we're seeing is this movement where we're seeing a change in employment is being almost matched by what we're seeing with a change in the labour force size. And that's kept the unemployment rate incredibly stable over the past half a year or so. So 4.1% is expected to remain the case for the unemployment rate. Some of the details within it potentially points to maybe an upside risk to that unemployment rate, which would go and help to go and solidify the belief that the RBA will go and cut rates come next meeting.
Now, of course, yeah, you pointed to that volatility we saw in the US dollar overnight. What are you seeing with the Aussie at the moment?
Look, it's just an added whim to what's going on when it comes to broader risk appetite. When things are looking good, it will go and rebound. When things are looking bad, it will come off. It's been the really primary driver of what's going on at the moment. Along with this, the curtailment of Fed rate cut expectations. You can see there at 65.20. It's been really range bound, but just choppy at this point. It needs another catalyst to go and continue this run higher. And to me, that's either going to be probably not from the US dollar weakness, because that would likely be sparked by something untoward in the global economy. But I think it's going to be something to do with China. And again, we saw some Chinese data out earlier in the week, not really giving anything there to the bulls. Yes, lots of increase coming through in industrial output, but when you look at domestic demand, still very, very soft. And until that changes, I think the Aussie is going to still struggle to get some meaningful upside from these levels.
And Scotty, interested in your thoughts on crypto. Obviously, we're in the midst of crypto week in the US with that regulation appearing to come. What are you seeing with the price action there, particularly with Bitcoin?
I'm glad you said price action, mate, because that's the only thing I pay attention to. There is so much noise in the crypto space, so many people trying to go and shill and get their worth of what they're trying to go and talk their book. To me, the price action is just always, it comes back to basic technicals, and a lot of the time they just pay out nicely. So the break that we're seeing, we saw a consolidation period, and then all of a sudden we're seeing a bullish break, and now we're seeing another consolidation period at this point in time. So at the moment, it still looks like the path of least resistance is higher. But of course, just keep a close eye on those price signals. They're often very, very reliable when it comes to both short and medium-term directional risks.